Welcome to the deep dive. We're plunging into the really critical shifts shaping our world. And today we're zooming in on something that's creating just incredible excitement, but also, frankly, some real uncertainty. That's the global clean energy transition. You see it everywhere, right? Solar, wind, electric cars. It feels like this global race towards a sustainable future is, picking up speed every single day. But what happens when a new, pretty weighty player steps onto the field? We're talking about tariffs. How might these trade policies disrupt or maybe just reroute this huge global shift? So, our mission today is to really dig into a very insightful analysis that tries to unpack the potential effects of higher tariffs on the whole clean energy industry.
Yeah, you framed that perfectly. Right now, the clean energy landscape, it feels less like a smooth highway, doesn't it? More like a bumpy gravel road, lots of unexpected turns. And those broad uncertainties you mentioned, they are really shaking things up. We're seeing geopolitical shifts, technological developments, creating pretty significant disruptions already. There's a noticeable shift in focus, maybe away from just rapid energy transition towards other big global priorities. The race for Gen AI leadership, increased defense spending, new trade alliances forming. And what's really interesting, I think, is how this evolving tariff environment just piles on top of all those existing uncertainties. It really has the potential to ripple through the global economy. We're talking impacts on energy demand, transportation, commodity prices, those complex supply chains. We're going to explore what might change, and maybe more importantly, what might not change. And I think some of the findings might be, well, a bit surprising.
That's a great way to put it, piles on top. Okay, so to really get a handle on the potential impact, this analysis didn't just look at one future. It looked at three pretty distinct hypothetical tariff environments. Could you maybe sketch out what those potential worlds look like? And maybe also touch on how the researchers actually set the parameters for the study?
Absolutely. So the analysis focused mainly on the United States and the European Union, which for this study meant the 27 EU countries plus Norway, Switzerland, and the UK, and it projected out to 2035, looking at capital spending and energy capacity across 5 key clean energy technologies: solar, onshore wind, offshore wind, battery storage, and EVs, electric vehicles. Now, it's really important to note what this analysis didn't cover. It didn't model any knock-on effects on energy demand if economic growth slowed down because of tariffs. And it didn't factor in other policy changes like, say, export controls or big changes to subsidies. And crucially, they didn't suggest any one scenario is more or less likely. They were just possibilities to explore.
Okay, clear boundaries then. So those three hypothetical futures, what were the actual tariff scenarios they modeled?
Right. So they were built using models from McKinsey and Oxford Economics. The first one, they called productivity acceleration. It was basically the baseline, kind of like the status quo back in late 2024. That included 50% tariffs on solar panels coming into the U.S. from China, 25% on batteries, and a big 100% on EVs, plus up to an extra 35% on Chinese EVs entering the EU.
Wow, okay, that's scenario one.
Scenario 2 was dubbed no real disruption. This one pictured a broader but maybe less intense tariff landscape. So the U.S. had 20% tariffs on all goods from China, 25% on goods from Mexico and Canada, and an average of 52% on solar modules coming from Southeast Asian countries.
Got it. Broader, less targeted, maybe.
Exactly. Then the third one, global tensions escalate. This was designed to model a future with really high tariffs, where trade relationships get, significantly tighter. It assumes 60% tariffs on all goods entering the U.S. from China and 20% on goods from other trading partners. And for the EU, it imagined an average tariff of about 47.7% on solar panels and batteries from China, and a really massive 140% on wind turbine imports from China.
Okay, those are some starkly different potential futures. But like you said, the real world is, well, messy and fast moving. What's actually happened with tariffs recently? How does the reality compare to those scenarios?
Yeah, things certainly move fast. As of, say, June 2025, China and the U.S. have actually paused those really high, over 100% tariffs that were discussed or in place between them. Instead, the U.S. applied an additional 30% tariff on all goods coming in from China. And China responded with a 10% tariff on all goods coming in from the U.S. The EU, meanwhile, it's continuing its tariffs of up to 35% on Chinese EVs, but hasn't really proposed or received broad new tariffs otherwise. So you see it's very fluid. It kind of dances around those scenarios.
Right. So even with these quite significant real-world tariff changes and pauses, the analysis suggests we'd need even higher tariffs, more like that global tensions escalate scenario, to see a truly fundamental shift in the energy landscape. That is quite a finding. It suggests maybe a surprising level of resilience in this clean energy push, doesn't it?
Exactly. That's really a core takeaway.
Okay, so let's break that down then. How does that really high tariff global tensions escalate scenario actually impact each of those five key technologies?
Right. So the big picture finding holes, no matter the scenario, these five technologies, they're still set for significant growth through 2035 and probably beyond. The main impact of tariffs, really across the board, is that clean energy tech will just cost more. Simple as that, in a way.
Okay.
So let's start with solar photovoltaics, PV. The manufacturing supply chain here is, well, heavily concentrated in China and Southeast Asia. China has a lot of the raw materials like silicon, which you need for the modules. And we've actually seen huge cost reductions in solar PV recently, over 60% just between July 2022 and July 2023. That makes it incredibly competitive.
Yeah, the price drops have been amazing.
Right.
So, given that concentration, but also the falling costs, what's the outlook for solar capacity, even with those potential high tariffs in the global tensions world?
Well, the projection is that solar capacity could still more than double in both the US and the EU by 2035 under any of the tariff scenarios. So still strong growth. However, under that really high global tensions escalate scenario, you could see maybe 9% less installed solar capacity in the US and about 7% less in the EU by 2035, compared to that baseline productivity acceleration scenario.
Oh, okay, 7 and 9%. Not insignificant when you scale it up.
Exactly. It might sound small as a percentage, but it represents a fair amount of lost capacity compared to what could have been. Could delay targets, slow momentum a bit. Okay, moving on to wind power, both onshore and offshore. Here, the manufacturing capacity is actually more spread out globally compared to solar. You've got significant production in China, yes, but also the EU, Mexico, and the US. Just to give you a sense of imports. The US imports about 17% of its wind equipment from China. The EU imports a larger share, around 36% from China.
Ah, interesting. More diversified. So for onshore wind specifically, which is often quicker to build, what's a growth expectation? And does that diversification make it less vulnerable to these tariffs?
Yeah, onshore wind capacity is expected to grow quite a bit, roughly 50% in the EU and about 40% in the US by 2035. Now, here's something really interesting, maybe a bit surprising from the modeling. It suggests that neither tariff scenario is likely to really affect wind capacity of the U.S. by 2035.
Really? No effect.
Pretty much, yeah. Largely because of that more diverse supply chain and the existing domestic production. For the EU, though, it's a bit different. In that global tensions escalate scenario where the EU puts tariffs on Chinese turbines,
Yeah.
you could see about 6% less capacity by 2035 compared to the baseline scenario.
Okay. And offshore wind. That faces, different kinds of challenges. Deeper water, bigger kit, more complex regulations. How does that fare?
Right. Offshore wind in the U.S. is facing a significant moratorium right now. That's likely going to pause new capacity additions until maybe the end of the decade. So growth there is limited mostly to projects already in the pipeline. In contrast, offshore wind is expected to grow almost threefold by 2035 in the EU. Huge growth planned. But in that global tensions escalate scenario, the EU capacity installed by 2035 could be about 6% less than in the baseline productivity acceleration scenario. Again, no real effect projected for the U.S. due to its specific situation. The EU's higher reliance on imports, particularly from China, makes it more sensitive here.
Makes sense.
Okay, next up. Battery Energy Storage Systems, or BSS. Now, China currently dominates the supply chain here. They're the main global exporter. However, the critical raw materials for batteries, things like lithium, cobalt, they're actually found across a much wider geography. Think Latin America, Africa, Australia. Lithium in Chile and Argentina, cobalt in the DRC and Australia. This diverse access to raw materials, it creates some fascinating opportunities for manufacturing supply chains to maybe develop outside the current hotspots, especially outside ASEAN countries.
That raw material spread does sound like it could be a potential game changer long term. So what's the outlook for BESS capacity then, given China's current lead, but also these global raw material sources?
We estimate BSE capacity will grow significantly, about 7% by 2035 in the U.S. and nearly 6 times bigger by 2035 in the EU. Massive expansion. Under the global tensions escalate scenario, though, this could mean about 4% less capacity in the U.S. and potentially up to 10% less capacity in the EU by 2035 compared to the baseline.
Wow, up to 10% less in the EU. That's quite a hit.
It is. And what's really interesting here is that the bigger impact on BES in the EU is partly explained by, well, just its higher volume of imports from China compared to the U.S. The U.S. already has quite substantial domestic battery production coming online.
Okay.
And finally, electric vehicles, EVs. Manufacturing capacity for EVs is pretty spread out globally. High production volumes in China, the U.S., the EU, but also Mexico and Canada. In fact, Mexico and Canada even host facilities for EU and U.S. car makers. Looking at imports, EVs themselves, excluding parts, make up about 30% of the EU market, mostly coming from China. In the U.S., imports from Mexico, Canada, and the EU represent about 35% of the market. So different import dynamics.
A truly globalized market, then. So how might those high global tensions escalate tariffs really affect the speed of EV adoption, especially thinking about the ambitious targets some regions have?
Yeah, good question. By 2030, EV adoption in the U.S. is projected to hit maybe 14% under that baseline productivity acceleration scenario. In the EU, where EV uptake is already higher, they could reach about 50% sales penetration in the baseline scenario versus maybe 41% in the global tensions escalate scenario by 2030.
So a noticeable slowdown, particularly in the EU.
Exactly. And this raises a really important question, right? That global tensions escalate scenario,
Sure.
with its potential drag on EV adoption, could create some additional headaches or considerations for the EU's planned ban on selling new internal combustion engine cars, which is set for 2035.
Yeah, they might need to reevaluate the timeline or support mechanisms if EV adoption slows down too much due to costs.
Precisely. It introduces another variable.
Okay, that's a critical point for policymakers. So stepping back from the individual technologies now, what does this all mean for the big picture? The overall penetration of clean energy, the energy mix in these regions. Does it truly derail the transition, or is it more like just making the road bumpier, as you said earlier?
Well, the analysis really indicates that only in a scenario of very high tariffs, like that global tensions escalate model, would the energy landscape fundamentally change in a substantive way. And crucially, the tariffs that have actually been applied and then paused recently, given how quickly things move, they might actually meet or at least approach that threshold needed to cause real change. But across the board, the fundamental takeaway is tariffs mean clean energy tech will cost more.
Right. So what's the specific impact on the U.S. clean energy share? Are we still likely to see that ambitious growth people talk about?
So in the baseline productivity acceleration scenario, the U.S. looks poised to reach about a 69% clean energy mix by 2035. That's up from around 49% today. Under both tariff scenarios, that figure drops just slightly to 68%. So still significant growth compared to today.
Okay, not a huge drop then.
Not huge by 2035, no. But here's a potentially surprising insight. The analysis suggests that the sustained imposition of tariffs, like in the global tensions escalate scenario, could actually stall the expansion of clean energy share beyond 2035. Also, independently of tariffs, the U.S. is projected to generate more energy from natural gas in 2035 than it does today. Tariffs could just nudge that proportion slightly higher, maybe 29% in the baseline versus 30 or 31% in the tariff scenarios.
So continued growth in clean energy, but maybe the pace slows after 2035 in the high tariff world, and natural gas picks up a bit more of the slack.
That's a good summary, yeah. The momentum continues, but the long-term trajectory might flatten a bit sooner, and the reliance on gas could be slightly higher.
And what about the European Union? Their clean energy targets are incredibly ambitious. How do these tariffs affect their path to a greener grid?
Yeah, in the EU, tariffs at that global tensions escalate level, they start to change the landscape a bit more noticeably. That scenario could lead to roughly a 1 percentage point greater share for natural gas capacity compared to the baseline scenario by 2035, and that extra gas capacity essentially comes at the expense of renewables. So if you connect that to the bigger picture, reaching that very high 86% clean energy mix they achieve in 2035 in the baseline scenario, well, that might happen 1 or maybe 2 years later in the global tensions escalate scenario.
So not a complete derailment, but a noticeable delay in hitting those crucial targets.
Exactly. It's a delay, not a stop sign.
Okay, so beyond just the capacity mix, what about the actual cost? How might tariffs affect the overall cost of these energy systems for, consumers and businesses? You said things will cost more, but what does that look like financially?
Right. So the scenario suggests the speed of the transition, the pace, probably wouldn't be drastically altered, at least not in the EU, just by introducing these tariffs. However, the cost of the energy systems and that result, that could be roughly 2% more in the United States and maybe 3% more in the European Union by 2050, according to this analysis.
2 to 3% higher cost by 2050.
Yeah. Now, it's important to say There's large uncertainty around those exact numbers, but the direction is clear. And we're already seeing rising costs in these industries today, even without those extreme tariff levels.
So the transition likely continues, but it just might come with a higher price tag for everyone involved.
That's the gist of it, yeah.
It sounds like a really complex environment for companies to navigate. I mean, what stands out to you about how clean tech companies, energy producers, network operators can actually prepare for this? How do they navigate this uncertainty? It feels like there's more to it than just the numbers.
You're absolutely right. It's complex. Even after modeling these different scenarios, a lot remains unpredictable. I mean, our analysis focuses on making and deploying the tech, right? But it doesn't capture all the supply chain connections that could be hit by tariffs, nor does it really model how energy demand itself might change if tariffs slow the economy. And of course, we don't know how long any set of tariffs might actually stay in place.
True.
But despite that uncertainty, the analysis does offer some, clear directional insights. I think for clean tech OEMs, energy producers, network operators, a really key takeaway is the need to examine their own portfolios. Look at their geographical footprints. Really map out their supply chains to spot the vulnerabilities, but also the strengths when facing tariffs. It's about proactively minimizing risk.
And the source material also mentions other factors, right? Like legislative changes or other trade issues that might be just as important, maybe even more so than tariffs alone. What else should companies be watching?
Absolutely critical point. For the original equipment manufacturers, the OEMs, the challenges really differ depending on the technology and the region. So their strategies need to differ too. Things like the future of major legislation like the U.S. Inflation Reduction Act that could easily matter as much or even more than tariffs in shaping the market reality.
Right.
Similarly, export controls on critical materials like rare earths.
Yeah.
That could have a massive impact given how vital they are for magnets and wind turbines and EVs, for example. So companies need to think broadly. Maybe focus investments where the market seems as sensitive to tariffs, perhaps pull back where demand looks likely to fall, and definitely work on diversifying supply chains. That seems crucial for adaptation.
Makes sense. What about energy producers?
For energy producers, particularly in the U.S., tariffs could just mean lower returns on clean tech projects, making some less attractive financially. Wind energy costs seem likely to be less affected than solar, so that might look like a relatively safer bet in some cases. And as we discussed, regardless of tariffs, natural gas looks set to be an increasing part of the U.S. mix just because it's currently low cost and energy demand is rising. In the EU, assuming tariffs don't cause a major rethink of their energy independence goals, investment in renewables is likely to continue. It just might cost more or proceed a bit slower.
And the grid operators.
The
Network operators, yeah. In both the U.S. and the EU, they could think about aligning their grid investments closely with where the energy producers are heading, planning for more industrial electrification long-term, especially in Europe, and absolutely critically, continuing to invest in just maintaining and upgrading the grid itself to handle this changing, more distributed energy mix. That's vital no matter what. Okay, so taking the broadest view then, this deep dive really shows us that, yes, the adoption of clean energy technologies will probably take longer and cost more the longer tariffs last and the higher they are, seems logical. But, and this seems key, the analysis also clearly shows that the adoption of clean technologies will continue. The momentum is there. It might just be at a slightly different pace or cost, reflecting perhaps a certain underlying resilience in this global push towards sustainability.
Indeed, that's a great summary. And those stakeholders, the companies, the investors, the policymakers who proactively really dig into their supply chains, understand their vulnerabilities and strengths in the face of tariffs, they'll be the ones best positioned to navigate this uncertain landscape, maybe even turn potential disruptions into strategic advantages.
So, a final thought then for you, our listeners, to mull over. Thinking beyond just tariffs, what impact might future geopolitical shifts, maybe unexpected new alliances, or perhaps emerging global rivalries have on the long-term feasibility of these national or regional energy independence goals, especially given, as we've discussed, the inherently globalized and deeply interconnected nature of these clean tech supply chains? Something to think about.